Good day, everyone, and thank you for joining us once again here at BBC for our quarterly briefing on the performance of our Community Bank Benchmark Group. For this briefing, we're going to go over how the Community Bank Benchmark Group performed in the fourth quarter of 2023. And for those of you who are just joining us, this benchmark group includes institutions with assets between 100 million and 5 billion. So we see here overall growth in terms of the quarterly growth of this benchmark group. The overall assets grew just less than 2% at 1.97, an overall increase from where we saw that growth rate in the third quarter of 1.04. Now, some of this growth, of course, has to do with the revaluation of the bond portfolios because rates came down. We saw the values in the portfolios increase a little bit. So some of that additional growth is due to the revaluation or improved valuations of the bond portfolio. However, we did see overall loans increase by 2.17%, up from where we were back in the third quarter at 2.11. Now, as we talk to different institutions, in different ALCO meetings and board meetings, we do know that loan growth continues in the first quarter of 2024, but we've seen it pull off just a little bit. So the overall loan growth of just north of 2% for the fourth quarter is strong, and we expect that to come off a little bit when we start to see the first quarter of 24 numbers come out. Overall, we've seen a pullback in the budgeted loan growth for 2024 compared to what it was back in 23 and in 2022. But as for deposit growth, we did see this deposit growth increase by 1.28%. From where it was in the third quarter of 1.26. That's the overall deposits. We strip out those broker deposits. We can see the net of the broker deposits, or we'll call these core deposits, increase by 1.07%. Stronger growth than we saw in the third quarter. And this has been the trend right now. We start to see those deposits come back in, whereas earlier in the year of 2023, we were seeing net outflows of those core deposits. So that's an important change in what we're seeing right now, is the fact that we are seeing the growth in deposits pick up. As for overall financial performance, we saw the return on average assets continue its decline. As we moved throughout 2023, we saw the tremendous margin compression happening. We can see here with the overall return on average assets dipping down to where it was in the fourth quarter at 0.89%. So below that 1% level when we look at the broader benchmark group. If we recall, we do split these groups up into subgroups. Those subgroups include subchapter S institutions. We can see where their overall return on average assets came in at 1.11, still above that 1% level. But as you recall, these subchapter S, they don't pay that federal tax and sometimes state. So that 1.11%, while it's above 1%, is still strong. We would hope to see that up toward 1.26% when we factor in the impact of taxes. So that's falling below where our target ratio would be for subchapter S institutions. Then we look at those stock institutions, and we can see they fell to 0.83 from where they were in the third quarter at 0.92. So we see that deceleration. Now, the overall mutual institutions maintain their level of ROA at 0.36. So that tends to be the overall lowest ROA that we see on this chart. because of the business model that mutual institutions have. And we can see that stabilized between third quarter and fourth quarter of 2023. So overall, we can see the reduction in performance for both the subchapter S and the stock benchmark groups, but the mutual institutions remained where they were in the third quarter of 2023. That being said, the decline in ROA of the group in total has been caused by this continued reduction in net interest margin. And we can see for the fourth quarter, we came down just 1 basis point from where we were in the third quarter of 23 at 3.35. But for throughout the entire year, coming off from where we were back in the fourth quarter of 22 at 3.6. So we had this tremendous decline in net interest margin, and we knew that compression was coming because the inverted yield curve. And we see the impact of that inverted yield curve on the yielding earning assets while they continue to increase. The overall level of increase in that cost of funds has been more dramatic and therefore causing that overall compression of net interest margin. Now, a portion of this cost of funds increase, of course, is the need to go out to the wholesale funding market to plug some liquidity gaps, and that gives us an overall higher level of cost of funds, but also just the increase in the cost of interest-bearing deposits has been tremendous, and which has really pushed that cost of funds up. And we see this here with the increase in cost of interest-bearing deposits going from 0.78% back in the fourth quarter of 22 all the way up to 2.28% in the fourth quarter of 23. So we had this tremendous increase in the overall cost of interest-bearing deposits. And as we think about ALCO and the assumptions that we build into our ALM models, we know that we have to build in assumptions for betas on our non-maturity deposits. And we can see here overall beta for the cost of interest-bearing deposits, that's including the time deposits as well as non-maturity deposits. From the end of 21, so this is the quarter just before the Fed began their tightening, we can see we were at a beta of 36.9% for the overall level of interest-bearing deposits. So we saw the level of change in terms of the cost of interest-bearing deposits increase by 194 basis points. When we look at just transaction accounts, you're looking at DDAs and NOW accounts, we can see that was up about 68 basis points or 12.95%. That beta of 12.95%. So that's kind of where we're falling in right now. And that's considering this 525 basis point movement in that Fed funds rate. So it's still fairly low, probably in line with a lot of assumptions in the models for the betas. When we look at savings and money market, the call report links these together. We saw those increase by 121 basis points, or 23% of the movement in the Fed funds rate. So still underperforming what I would think was going to be the push. I would typically, historically, put that around 40% to 50%, but we've only seen that increase by 23% on average when we're looking throughout this community bank benchmark group. Now, of course, your numbers are specific to your institution, so we should be doing this type of analysis to see, in terms of a back test, what has our overall cost of funds and cost of interest-bearing deposits done compared to what we say in the model and our projections. And that's an important process to walk through. And if you want us to do that for you, feel free to shoot me an email or give me a call. But in terms of the cost of time deposits, both jumbo and retail, we can see those are much higher in their betas, 62% for the jumbo CDs and 54% for retail CDs. So those are both much higher than we see at non-maturity deposits, and that's what we would expect to see. But when we look at the mix of the deposit portfolio, we continue to see time deposits gaining, but we are, if you would notice, just getting back to where we were pre-COVID. So pre-COVID, we had an average of about 28%. If you look at the 3 years prior to COVID, and we're back up to about 26. So we have a little bit ways to go until we get back to that average. So that is more of like a reversion to the mean for this benchmark group in terms of this flow from non-maturity deposits into time deposits. But we can see what one difference is this overall growth rate in broker deposits at 51% for the fourth quarter. We know that we've had to use this wholesale brokered market to fill some gaps. So overall, when we look at year-over-year changes, we were up about 51% in utilization of those broker deposits. We saw non-broker deposits increase by just 67 basis points, or 0.67% year over year, much less than what we saw back in 22 and 21. And that's that migration of deposits that has had an impact on the overall level of our cost of funds. We had one impact being the rate that we're paying, and that second impact just being that flow of funds out from these lower cost non-maturity deposits into those time deposits as we're running those specials throughout the year. And that's the next thing we have to come to face as we look into 2024. We have to determine how we are going to deal with the renewals of those time deposits, those specials that we put on at the beginning of 2023 and that are coming due. How are we going to treat those? Are we going to put another primo CD out there? Or are we going to try and move some of those funds back into the money market accounts? That's going to be a strategic decision that banks are going to have to deal with as we move through the first 3 quarters of 2024. In terms of operational efficiency, we did see net overhead increase quarter over quarter up to that 1.98%, similar to where we were back in the fourth quarter of 2022. And we know fourth quarter tends to see an increase in net overhead. And just a reminder, net overhead is the difference between non-interest expense and non-interest income. So in terms of non-interest income, been pretty anemic in its change, right around that 44 basis points throughout the year. And non-interest expense has been a little more volatile, and we're up to that 2.51% for the fourth quarter, just 1 basis point higher from where we were in the fourth quarter of 2022. So operational efficiencies continue to be one of the key areas that we're looking into in order to maintain our overall performance in this environment where we're seeing that net interest margin continue to come under pressure. But in terms of the overall risk, as measured by the S&P Total Risk Index, we can see we did have a slight downward trajectory in total risk, coming off just a little bit. And when we look at the components of that, we did see the capital levels improve, primarily because of the improvements in the valuations in the bond portfolio. So that picked up a little bit, but we did see the liquidity risk improve slightly as well, which gave us the ability to pull down the overall level of total risk. And that improvement primarily is due to the influx that we saw of the deposits, not coming from those, or at least as much from the wholesale market, but core deposits coming in to the bank from our customers. So that has been an advantage that we saw in the fourth quarter. We hope to see that continue as we move throughout 2024. We also saw a slight improvement in the earnings at risk score as we saw the net interest margins, albeit they came down. The rate of change of those net interest margins has been smaller than what we've seen in prior quarters. So we see that overall level of earnings at risk improve slightly. It still remains in this moderate to high level area. So that's what we have for you today regarding the performance of the Community Bank Benchmark Group. Continue to operate with an overall level of return on average assets sub that 1% target that we like to put out there. And a lot of that is due to this margin compression that we continue to see because of this inverted yield curve environment that we are in. We're in the 17th month of this inverted yield curve, which is one of the longest time periods we've been in an inversion throughout history. So unfortunately, I wish I could say that's coming to an end. It does not look like it. It seems like we're going to be inverted in the yield curve, most likely throughout most of 2024, but we'll continue to reevaluate that forecast as we get new numbers from the economy coming out and the different aspects of what the Fed's doing with the Fed funds rate. So that's what we have for you today. We hope you have a great week and a wonderful quarter. We'll see you again next quarter. Have a good quarter.